Hi, this is George Sandmann. I'm the founder and CEO of Growth Drive. Growth Drive is the #1 best-selling business advising platform, and this is our podcast, The Business Advisor Hot Seat. Now, in the hot seat, you're going to hear from industry leaders, thought leaders, your colleagues who are going to share tips, techniques, war stories about building a thriving advisory business based on delivering client wins. We're going to get into it. We'll get into it about the Growth Drive methodology, the Clarity software, what we see out in the world, so much more than just the system. And I'm also the author of The Growth Driving Advisor, which is based on over a decade of being an advisor to advisor, working with you and your colleagues, helping them build their practices, helping them through client engagements, and it's really proven strategies for leading businesses from stuck to best in class. Check it out. So strap in. We're going to light this up. Here we go. Well, welcome back, everyone. This is George, and I'm here with my good friend Steve Cummings, Stephen Cummings of Rizolve Partners. Stephen, rather than me introducing you, why don't you introduce yourself, please? You and I have been working together for a very long time. I'm psyched to have you back in the hot seat, and tell people who you are and why your clients hire you.
George, absolutely delighted to be here. You're absolutely right. We've known each other for a long time now, and long may it continue. As far as I'm concerned, we certainly unearth a ton of value in a myriad of ways. So happy to be on your podcast again. So for your listeners, my name's Steve Cummings. I'm the managing partner of Rizolve Partners, which is based up in Toronto in Canada. I regularly come down to George's summit every year to meet all of the growth drivers. Our practice is both helping our clients deliver on growth, but more importantly, or as importantly, we're an exit planning practice as well. So we combine the two. In an ideal world, we find clients that want to exit inside of a 5-year period. If that's true, then the impetus for growth is certainly there as far as we're concerned. And with our clients, George, I'll just mention this, right at the beginning, because you and I talk about it a lot. We like to think of ourselves as advisors, not consultants. We're not there to come in and tell people how to grow and give them a report and then walk away. One of the things our clients really like is that we're there along for the ride with them, helping them to achieve growth.
Love that.
And growth is important ahead of an exit because you want to put your best foot forward. You want to present yourself in the best light. A growing company is what buyers want to see. So we're delighted to work with George and his group of advisors, and we love it.
Awesome. Thanks, Steve. It's funny. I'm really psyched to see you in October. Shameless plug, October 5th, 6th, and 7th here in beautiful Charleston, South Carolina, the Growth Drive Summit. I'm really psyched to see you, and thanks for coming again. I don't think you've ever missed one, so I'm psyched to see you.
Try not to.
You do. I think once you were in Europe on vacation, and fair. What's interesting is the summit. You mentioned exit planning, you mentioned growth, and growth is critical, right? Growth is the thing that contributes to value. Predictable, sustainable growth drives value. And we shorthand that as strategic capacity drives value. But this year, the summit's going to be about growth, right? We're purposefully not focusing on exit. We're focusing on growth. And you and I both know, and I love your comments, essentially all CEOs want to grow their business. So I called this company Growth Drive because as entrepreneurs, we have this drive, this almost maniacal drive to grow the business, to always be growing the business. And it's a very small percentage of CEOs who truly want to throttle back. What we see actually in the data is that CEOs may come in and say, hey, man, just make this easier to run. When they do, and the business starts to grow, which is inevitable, according to the data, they end up back in growth mode. So I'd love to hear you to elaborate a little more on growth, what you see with your clients, and in the context of an exit potentially. But maybe we'll chop that in two, right? Let's talk about growth and what you're seeing.
Yeah, so I think there's a couple of words that you use there that are really important, George. Sustainability and predictability are two words that we use a lot with our clients, but we focus on those two things fairly early on. So when we're asked when we find a client that is ready to take on the challenge of reinventing themselves, pivoting to value. When we find that client that's pivoted and is willing to accept the challenges that go around that, during discovery, what we're really trying to assess is how firm the foundation for growth is. And that's level one, value drivers in the parlance of growth drive, and we spend a lot of time on that. We spend a lot of time figuring out in a 30-day discovery period what the quality of the foundation is. Is it sustainable, or do we have a view that it is sustainable, and is it somewhat predictable going forward? If the answer to those two terms is yes, then that's a good thing. It's a really good thing. It may be that some of the foundations need maybe rebalancing. Maybe there's a focus on particular areas, and often that's the case. CEOs hire in with their own skill set in mind. Often, and so maybe there's a bit of rebalancing. And one of my partners is a sales acceleration partner, and so read growth,
Yes.
into that, or top line growth into that, and he really wants to know a couple of things right out of the gate. What's my target? What's the planned target that you want me to achieve? Because that kind of talks to velocity of sales and how many, what the health of the funnel is, and so on. But we're all conscious that before we accept the challenge of putting our foot on the accelerator, before we accept that challenge, are the fundamentals to be able to grow in place. And the reason we want to come to a view on that is because often, and you see this a lot, often there are unintended consequences to growth. And the unintended consequences arise from a lack of solidity in the foundations for growth, and also maybe an imbalance in some of the value drivers that we put. Sustainability, predictability, but and really that assessment's coming from how firm's the foundation.
I absolutely love it. It's interesting because you've said something earlier, and then you've just re-implied it. The difference between being an advisor and a consultant, and the fact that you are very intentionally an advisor, not a consultant, because you are there to help to make sure that the client achieves, and I'm putting words in your mouth, but you make sure that the client can achieve the success they've defined for themselves, which is all part of your qualifying, which we talked about in an earlier podcast. And so what happens when you come in and your intent is to be there for the long term, and your clients understand that from the first conversation? And what does it look like when you find, let's go with the harder cases, right? When you find a weak foundation, and when you say foundation, are you referring to what I call predictable profits and cash flow, or something additional?
No, that's exactly how we define it. We want a company that is operating sustainably. In other words, it's got predictable revenue. The gross margins that it's achieving from those revenue are benchmarked well, with other companies in the segment that they operate in, and as a result of that the cash flows flow into the business in order to provide the lifeblood for future investment, and I'm thinking in particular on the marketing side, the virtuous circle of marketing. We want to feed the monster. We want cash flow to feed the monster. The monster's going to go out there and radiate the message to the market as to the services and products that the company provide. That's going to tie in with our sales efforts for growth and so on. But we want predictable profits and cash flow in order to be the cash flow being the lifeblood for growth.
100%, 100%. Well, it's interesting. A lot of people, and I just want to, for you and I, it's stating the obvious, but I want to make sure our audience hears. So if when you help a client create a business that has predictable and sustainable growth, top line, bottom line, that still doesn't mean that the business can go through any kind of, that it hasn't achieved the asset class, right? It doesn't mean that it can transfer a top value, that the two are related, but there needs to be a purposeful connection. Could you comment on that?
Well, absolutely. We certainly want to see a firm foundation. The company has a product or a service that the market is willing to spend money on.
Yes.
So let's take that as read. Achieving growth, however, is quite a complex model. In order to achieve growth, we need a sales team that can pitch the product to the market in a way that generates prospects, leads, and concluded sales. The flip side to that, from a valuable company's perspective, is that the operations need to be able to deliver on the promises made by sales. And they need to deliver on those promises in a way that makes the customer happy with what they've received. In other words, a satisfied customer. So the flip side to growth, once you've got a firm foundation, is building an operational engine that can do that. And you will see in growth companies that the operation, once they've achieved a firm foundation, it's the operations that then start to have issues. Do we have enough people? Is the product or service that has been offered, is it of a high enough quality that meets customer expectations? Can the operational engine deliver efficiently, and so on, once an order has been received, and so on and so forth. So there's a number of value driving variables that a company needs to step up to and deliver on once the foundation is there. The other thing I would say is, back to those two phrases that we used earlier, George, is sustainability and predictability. Well, in order to have a predictable business, you need to have a plan. You need to have both a long-range plan. It can be abbreviated, but you need to have a view as to where you're going through the mirror of the organization, and you need to fine tune that long range plan into achievable goals, typically annual achievable goals that then stimulates the organization in order to achieve those goals, and so on. So you need to set expectations, set expectations with customers and suppliers and also employees, so that they can rise to the challenge. So there's a number of variables which cause complexity in achieving growth, but the stepping stones, and to achieve growth are fairly well tested these days. And certainly, we try to steadily improve every aspect of the model or the engine with our clients to stimulate growth.
Yeah, 100%. 100%. I'll just leave it there. It's interesting because as you and I've been working together for a long time, your business, Rizolve Partners, has also evolved, right? And you guys are growing nicely. What have you learned? So you have a lot of experience helping set the foundation, helping deliver the growth, and as you said it earlier in this conversation, one of your main qualifiers, or your key qualifiers, I should say, is whether someone is looking to recapitalize or potentially sell within in a 5-year window, 5 or so, right? Could be longer, could be less. How have you managed to? What do you think are some of the keys to having grown Rizolve Partners, and then and you're working with increasingly sophisticated companies, larger, more complex? I'd love to hear your thoughts on that in that area.
So, firstly, the qualifier of wanting to achieve an exit at some stage. It doesn't need to be a retirement situation. It could be a young entrepreneur that has built a valuable business and wants to, get some more free time and get some liquidity and move on to their next act. So. But what we find with growth is that it isn't a quick fix. It isn't a switch of a switch of a light bulb. It isn't having an exit is not like selling a house. I've got a house. I've put a coat of paint on it. I want to sell. And I want to sell inside of 3 months. If we hear that, and we have heard that numerous times, then we got to say we're a pass, because you're too far along. We're not consultants. If you're into preparing for a transaction, that's a full-on process that you need consultants, not the type of advisory work we need. So, however, if there are entrepreneurs who want to get liquidity on their investment, that's a real motivator for us. And I'll tell you why. Because a good proportion of the work that we do is value growth work. Yeah. And as you quite rightly say, many CEOs want growth. They want top line growth. We are experienced in converting top line growth into valuable growth. In other words, cash generating growth, amongst other things. So the hook of needing an exit means that if there are difficult elements to pivoting to value, and there often are, and they are often issues that the CEO or the shareholder has studiously avoided because it's too tough to go down that path.
Yes.
And so the hook here, and this is important for everyone to understand, is the hook here is if you want to get to an optimal exit, an optimal for you, the owner, you want to get to an optimal exit, you need to deal with the value drivers that a buyer expects to be in place. And if they're not in place, it's a problem. It could be a terminal problem because the buyer turns away and said, that this is not what I'm looking for. And in the business, we call them deal killers.
Yes.
It could be over concentration in a particular customer. It could be lawsuits because the entrepreneur's argumentative. It could be reliance on a business owner. So they might be terminal. So that hook is important in order to draw through the entrepreneur through to an optimal situation. So we're addressing tough things often, which is why 3 to 5 years comes into play. And that was a tough one for me to get over. Whilst I thought that as a business owner that was a correct period of time, it absolutely proves out to be a correct period of time in order to convert weaknesses into strengths.
Yes.
And so that hook, that pull through to convert difficult things is the thing that I would really kind of say is important. And let's just flip that and say we're talking to a CEO that's got no intention of exiting. The problem with that for us as an advisor is what happens when we get to a difficult proposition with that CEO and he goes, I've got other things that are as important for me to deal with. That then puts us in a quandary because some of the foundational issues or some of the significant value driver issues, for example, a strategic plan, putting a strategic plan together. Some of the significant value driver issues may be pushed to one side, and it means that the company either takes longer to get there or fails to get there because they're not putting the fundamentals in place.
Yeah, it's interesting. We talk about the consequences of not getting there, the consequences of failing, and I love the pressure that you're looking for. It's that do or die. You are either going to address this issue, because what you're saying is essentially the CEO is as we joke, the bacon at breakfast, right? They will either get this done or it will cost them. And the consequences of failure are very real. For the CEO who isn't, if I'm hearing you correctly, for the CEO who isn't contemplating a recap or a sale, they actually can say, well, I'm not dealing with that. I have something more important to deal with. And there's no real consequence, right? The consequence will play out over the long term, not by a date certain. Am I hearing you right?
I think that's right, George. I mean, just using some of the terms that we've used earlier, the difference between a CEO and an organization that is top line driven at all costs, and sometimes experiencing the unintended consequences of top line growth,
which we both see.
Because sometimes growth can have zero value add or be value diminishing if some of the unintended consequences reduce client satisfaction, or if growth causes lawsuits because the delivery of a service or product isn't what customers want, and so on and so forth. The delta here is the pivot to value. What is valuable to a buyer? What is valuable to buyer if we're only concentrating on top line growth is, firstly, what did I say my sales acceleration? What's the first question my sales acceleration lead says to me on any client is, what's the target? right? They want to know what the target is so that they can build a funnel with prospects, which is probably 3x what they're actually going to realize in order to deliver on the plan.
Yes.
So, is the revenue that you're bringing in recurring revenue, and is it sustainable recurring revenue, or is it one-off? A one-off sale is great. I'm not knocking it because it drives gross profit and cash flow into the business. So you will get some credit for a one-off sale from a buyer. You will. However, it's not as valuable as if you brought in repeatable, demonstrably repeatable sales
Yes.
with a contract underpinning it, and you'll potentially get a multiple applied to that revenue as opposed to a one-off. So when we talk about pivoting to value, the kind of intangibles that we want to see, we want to see a good customer relationship management system. Why do we want to see that? Because it evidences a pipeline of future prospects that are going to feed the sales monster.
Yes.
If we have that in place, we want to see consistent delivery with satisfied customers. So we need the data, we need the tools and the systems in place. We need the labor at the right level so that timeliness of the promises that sales have made are, the timeliness of the delivery is there, and we need evidence on the satisfaction of customers once they've received the product or service and the after sales service and so on. So there's a number of features to value. When we talk about value, it's a complex word, value. Business value is a complex word. You speak to the accountants, everybody gets confused because, the calculation of value, is a complex beast that you get an 80-page report on. The type of operational value that Growth Drive highlights is, in my view, highly valuable to business owners because it gives them visibility to the operational value drivers.
Yes. I love that. I love that because I know that you are, and you and I have discussed it, and I discuss it with a lot of your colleagues. We're helping them deconstruct this stew, this voodoo they have about all the things that are going on in the business, and we help them break it down so that they're intelligible parts. And you've hit on them, right? Okay, I need to have satisfied customers, so operations has to deliver on time and to spec. So salespeople have to set proper expectations. So marketing has to bring in people. These are all linked together, and they're gears in this often profoundly complex, but at the end of the day, well understood and actually relatively simple business engine. And I just said something contradictory, but there are 24 gears, at least in the way we define the world. There are 24 gears in the business engine. And I literally, it doesn't matter if you're a dental practice or a multinational, those 24 gears are there. The complexity comes in with the scale of the business, right? How big is it? And if you have 10,000 people operating in these 24 areas, that is a different level of complexity than the dental practice that has a dozen. But they're the same goals and best practices that need to be demonstrated. Love it, man. Thank you. Sorry to jump up on my soapbox.
Well, I'd just like to pick up the complexity piece, George, because you're absolutely right. Over time, we have taken on board more and more complex customers, but the issues are the same.
Yes.
The difficulty with more and more complexity, with more employees, with a senior leadership team that has the challenge of the day to day and concluding transactions regularly. The difficulty is carving out time, good quality time, to think about how you're organized and think about whether it is organized valuably. And I'm happy to say that having been a global CFO and having been in private equity venture capital and seen around the deal table on a Monday morning all of these challenges happening on a
Real time,
daily
yeah.
basis. I'm happy to say that we're in the advisory. You and I are in the advisory world. I know you've been in a large complex company as well. We're on the advisory side, and we do have the privilege of being able to bring to bear the view of the 24 value drivers, the pivot to value, and and creating visibility around a prioritized action plan that moves us up the value curve. And it is a privilege. I love what I do.
Yeah.
I love working with Growth Drive and the model that you've put together, because I really think it adds value to entrepreneurs who lack that visibility. And I sympathize with them. I sympathize with entrepreneurs because they are sold siloed wares by many advisors. And Growth Drive and certainly Resolve, we try to pull the story together for entrepreneurs.
It's interesting. You just said something so critically important. They are sold siloed services, products and services. And absolutely, if you go out, and I haven't done it in several months, but it was for a long time. If you put into Google, for example, growth, or Safari, which is Google, if you put in, I want to grow my business, you're going to get pages of marketing, right? And that's one silo that contributes to growth, but it is certainly not. But it leads CEOs to believe that. And how often do we hear, "I need more leads, I need more salespeople, I need more sales," and that's one slice of the apple. I love the point that you made is bringing in a holistic perspective where we're going to focus on the whole engine, and not just simply say that this gear is the most important gear. It may be the top priority gear right now, but it meshes with all 23 others, and they are so often. There are two things, right? They're sold siloed products and services, and they're also, most CEOs, and I know that when I sat in the CEO seat, I felt like I had a target in the middle of my forehead, that people were aiming at with spend money, buy something from me, which and may or may not be the right decision.
Sure.
So you're giving them some context and wisdom. Sorry to interrupt.
Try to. In 30 days, in our model, we do a discovery. We promise a review in 30 days. I don't mind describing that to you.
I'd love for you to.
We go into a company. We talk to the business owner. We talk to all of the management team.
Awesome.
But we also like to identify the key employees in the organization, and we call them the go-to employees. They could be an executive admin. They could be someone down in the dispatch department that everybody goes to. We don't really care. We just want a purview as to what's really going on in the organization. And a CEO will tell us what he wants us to hear and filter it often. So we triangulate with different people in the organization, but the go-to people we want to hear from. We do a clarity review. Clarity is the software that Growth Drive has conceived of in order to evaluate the 24 operational value drivers. So we always do that. We do a deep dive on using Clarity software, and we come up with an evaluation of the 24 value drivers, and we assess strategic capacity. In other words, how the engine presents and whether it has got horsepower in it. So we do interviews across the organization. We use a software tool, best-in-class software tool, in order to benchmark the company in a particular segment. And then finally, we use what we call our biased heads, our biased opinions, in order to assess what we think.
Yeah.
We put all of those three things together inside of 30 days, and then we present what we call a prioritized action plan. It is not sugar coated. If you want to hear what you want to hear, we're not the people to employ. What we want to do is get you to a value pivot. And in order to do that, you need to hear it the way it is. Yes. And that's what we deliver. And the prioritized action plan basically ranks the operational value drivers. We come up with a set of prioritized recommendations as to how we can deliver value, typically over a 24, 36-month period. 5 years is a little bit too far down the road, 24, 36 months. And we see what the business owner makes of it. It's interesting, though, George, because in many cases, they are happy to hear the unvarnished, because we're within, the four walls of a sure. boardroom. They're happy to hear what we tell them. There's not too many people go, "Thank you very much." But sorry, this is important. We are totally happy after 30 days in a prioritized action. We're totally happy if someone turns around and says, "Thank you very much. We hear you, just not right now." Or, I understand what you're telling me. I need that, and I need it right now. Two ends of the spectrum. We're totally happy with either result. Why are we happy? Because we need a motivated CEO or shareholder who is coachable and who is prepared to act. If we don't have those three things, we will say, "Thank you very much, not quite for us," because it will fail if we don't.
It will fail. The client will not get the ROI. Yeah.
The client will not get the ROI. It'll be a waste of money, and it will be a tricky exercise. So we want motivated people to act. In a perfect world, they're 3 to 5 years away, and their age profile often is determining that they have a need to go there, and then off we go.
Yeah, I love it. I love it. It's interesting. The strategy planner, our strategy planner, which is being integrated into Clarity, even as we speak, is a 3-year. I think you and I both, based on our experience, 3 years is a reasonable window. 5 years, you start getting into, it's hard. Who can predict the market 5 years from now, right? And then 10 years is pure, in my mind, pure BS. But people talk about it anyhow. Yeah, I love it. You keep coming back to, or I guess it's implied. One of the from the outside, and someone who's been working with you for a long time, one of the key drivers of your success is you are very patient qualifying clients, and you have no problem saying you don't meet our qualification criteria. And the qualification criteria, I want to be very clear with the audience. You're not saying, Steve, we need to be able to make a ton of money, and therefore, if that's not possible, we're not going to work with you. What you're saying is you're not going to see an ROI. We don't think that you're going to do the work, and therefore anything you invest in this process is going to be money that you go do something else with your money. Do I have that right?
It's very simple, George. The CEO shareholder would demand an ROI from us, and we're saying we're very confident that we can deliver on that ROI. However, you got to play your part, and that
Yes.
might involve capital investment. That might involve changing some of your, highly likely that you're going to have to change some of your priorities. They may be fundamental priorities, and are you prepared to do that? Because this is what the buyer community, certainly a sophisticated buyer community, is looking for. we can absolutely guarantee that we're not going to waste your time. We're going to be concentrating on things the buyer community is looking for, and if you're not prepared to do that, then you've got your own reasons for having that point of view. What we're saying is that you're probably going to sub-optimize, or it might take you longer to get to where you want to get to than you would be prepared to pay us for.
Yeah.
It might take 10 years rather than 5, or 5 years rather than 3, and so on and so forth. So yeah, it's we have one client that is in the middle of a transaction right now, George. We have worked with them on the value growth side to prepare them for the transaction. We put a strategic plan in place that's going to triple the revenue.
Nice.
We have put a strategic plan in place that is going to improve the bottom line inside of 18 months by 50%. We had 5 bidders, actually 6, 5 bidders, third-party bidders, plus an internal candidate for the business. We have been able to move the valuation up through the transaction by 20%, using an investment banker to, but fundamentally, having put the data room together with all of the evidence of value for the company, fundamentally what we've been able to do is to add value ahead of the transaction. We brought in a sales specialist to further accelerate value through a competitive bid process. The value that we were able to present in a confidential information memorandum attracted multiple bidders, 6. We've now funneled down through a letter of intent to one of those bidders. They're a strategic acquirer with private equity funding the bid. So they're a sophisticated outfit. And these are the types of things that are possible having done the growth driving, value driving analysis, laying it out professionally through the transaction process. These are the value added things that are possible that add to not only the price of the transaction, but minimizing the obscure terms that often get put on the table. So there is no deferral. It's essentially a cash price. There is no deferral. There's a 10% deferral for 6 months. That's nothing. It's essentially a cash price. And these are the types of things that advisors in the Growth Drive group do every day of the week. This is what we do.
It is what you do, and you go. You will often go at risk and say, "Hey, listen, we'll participate in the win and sacrifice some compensation today," which I love. Which goes back to your qualifying, and we've talked about that in other conversations. I know it's something the community's fascinated about, and people comment if you would like to have Steve back on to relitigate that topic. We can. I'm happy. I'm sure Steve, you'd be happy to do that as well.
Sure.
It's interesting in this. Let's focus on this transaction. We just released a white paper on the asset class and helping private equity better prioritize deals in terms of hitting their ROI. And it's getting a lot of excitement from private equity groups. In fact, I'm meeting with a group again tomorrow morning who is fascinated. Are you communicating strategic capacity as a call out in the transaction, or is it something that's kind of implied in the deal?
So that's a very interesting question. I would say that we are more than happy to do that. I believe that it is a strong, persuasive piece of evidence at the back end of the transaction. You know, timing of the insertion of that information in the transaction is important, because for anybody that's been through a liquidity event, what they know is that it's a very defined process.
It is.
Every step of it is defined. If you're a business owner that has never done a transaction in their life, you need to understand that. And having a team of advisors around you that deal with the transaction environment day in, day out is super important.
And is proven to deliver higher value, much higher value. Yeah.
And proven to deliver. I do believe the concept of strategic capacity fed to the right acquirer, a strategic acquirer with an experienced team, a private equity group that is bidding. I do think there's a place for it, George, and I would say that without actually putting the analysis on the table in this particular case, I do believe that we've addressed it, and it's super important to do that, because we are, breaking down intangible assets into 24 value drivers systematically, and putting an evaluation on that, and justifying each one of the evaluations with evidence in the data room, is pivoting to value and delivering value through that exercise.
Yeah, and what you're doing is, you're doing a masterful job of allowing the buyer to have confidence that the business will continue to predictably and sustainably grow. And you were saying we have the evidence, which is what a lot of business owners need to learn and need to gain the education, which is why they should be hiring you. Very, very cool. Listen, man, it's hard to believe we've been talking for a little over 45 minutes. And I love these conversations, Steve. Thank you very much for your time. In fairness, are there any topics, questions you'd like to cover before we call this, give it a wrap?
I think the important point for business owners to understand is, if you've never been through a transaction in your life, if you have built a valuable company, that you have a team of people around you who are not experienced in transactions, then bringing on a growth driver who has inevitably a vast amount of experience in business. It may have been an accounting firm, may have been an M&A lawyer, it may have been a former CEO that's sold a business, and so on. Bringing on those types of people, in addition to an experienced professional advisory group. And the backbone to a professional advisory group would be, in my view, an accountant that has transaction experience.
With transaction experience, yes.
A lawyer that is in the market for a living, not general counsel.
Yes.
Not someone that does your governance. Someone that is in the market and knows what market terms are today and yesterday and what they're likely to be tomorrow. An accountant with transaction experience, M&A lawyer, a tax advisor who can give you planning, organizational planning to minimize tax more than 2 years ahead.
Thank you for saying that. As early as humanly possible.
Early as
Today.
possible.
Do it today.
And here's why you're 3 to 5 years, George, because you need minimum 2 years on tax
Yes.
experience, right? So there's those three. Then you need a specialist salesperson. A specialist salesperson is either a broker or an investment banker.
Heard.
Both of those people come at very high cost. However, they can give you, in their own right, a specific ROI because they can bring a competitive bid to the table. So those 4 or 5 specialists are critical. In a perfect world, you need someone in the middle, someone like a growth driver or an exit planner, or someone that is pulling the group together and creating a transaction strategy to get you across the line. So, George, in conclusion, for the business owner, you need a team. The earlier you start with experts like the growth driver group that George has got, the better. And if they can focus you towards getting, into a transaction properly planned, then you'll have get a good return on your money.
100%. And yes, and success in a transaction is defined a number of ways, and simply closing the deal. I'll make a comment. I love what you just said, and I thoroughly agree. And you and I talk about AI, right? And the wisdom that you bring, the wisdom that your colleagues bring, the wisdom that the team you've just described brings to the table cannot be replicated by a machine. Wisdom is a human trait, and the wisdom and coordination are the keys to success. Period. Sure, some people get lucky, but for consistent success and success in all its forms, wisdom is a critical element. And humans, the more you involve humans, the better. And
well, there's another word I would like to add to that, George, very quickly. There's another word I would use as well, in addition to wisdom, is, if you're a business owner, an entrepreneur, and you don't have experience with transactions, trust is important too. Having trust that someone can help you navigate the potholes of the growth, the pivot to value, and through the trust that people know what they're doing and they're going to navigate around those potholes efficiently for you. That trust factor and pulling together a complex set of variables is so obviously you're employing the wisdom, hopefully, but the trust factor that you're gonna get there efficiently is important. And AI has a place. It will more efficiently get us to where we got to get to, but I don't think the having the team that you can build trust with you that you're going to get across the line, both from a top line growth point of view, growth drive, but also through to your your own personal goals on liquidity and wealth management. Having that trust factor is really important.
I love that, and I can't help but pile on a little bit. That trust. This gets back to qualifying, and to a client who trusts, who for whom you have earned the trust, and who is willing to be transparent. Because if they're not transparent at the beginning and throughout the transaction about what they want, how they define success, and that can change, right, ladies and gentlemen. That will often change over the course of an engagement, over the course of a transaction, sometimes radically. The trust. You're absolutely right, man. And what a great note to close on. Trust is the name of the game, and yeah. As usual, you and I are in profound agreement. Awesome, man. Listen, Steve, thank you so much. Thanks for your time. Thanks for sharing your experiences, what you've learned, your wisdom. And I'm really looking forward to seeing you here in just 90 days, something like that, and in just a few short months down here in Charleston.
Time flies when you're enjoying yourself, George.
That's 100% right, man. And we are having fun. There's no question. Awesome. Okay, Steve, thank you very much. And I'll talk to you very soon. Hey, by the way, ladies and gentlemen, Steve Cummings, his contact information is below in the link below. Okay. Rizolve, Rizolve Partners. And if you have questions for Steve, I'm sure he'd be happy to answer. So thank you.